Good afternoon and welcome to our latest Lunch and Learn. My name is Glenn Reynolds. I'm a partner in our indirect tax group and I'm delighted to be joined by my colleagues Finbar O'Connell and Etna Kennan in our indirect tax group and John Curry in our tax transformation and technology group. So the purpose of today's webinar is to talk about the recent VAT rate change. So we're going to talk about who will be impacted by the change, how should you prepare for the change, and in particular, what systems changes do you need to implement between now and 1 September. We're also going to look at the warehousing of VAT debts, and in particular, we look at the legislation or the draft legislation which issued last week. And finally, we'll end on a positive note. So we look at potential for VAT cash flow enhancements and how you can maximize VAT cash flow and savings in your business. We'll leave some time at the end for any questions people want to get through. So if you'd like to ask any questions, please press the Q&A button and send them through, and we'll try and answer as many questions as we can. So the VAT rate change. So what is changing? So as everyone probably knows by now, the standard rate of VAT is going to temporarily reduce from 23% to 21% from 1 September 2020 until February 2021. Now, the standard rate of VAT applies to a wide range of goods and services. Ballpark 50% of products within the VAT net attract the standard rate of VAT, including motor vehicles, adult clothing, electrical goods, professional services. Now, this is the first rate change since 2012. When the VAT rate actually increased from 21% to 23%. Now, it's important to note what is not changing. So not all rates are changing, and in particular, the reduced rate is not changing. So the 13.5% rate will continue to apply, for example, in the tourism and hospitality sector. But if you are in that sector, you may be impacted because, for example, with a meal, while the food qualifies for 13.5%, if you were to sell alcohol, it always attracts a standard rate of VAT. Maybe to look at the policy on it, and why did the government go for a standard rate versus maybe a reduced rate cut? If you look at the pricing on it, so the stimulus plan costs the change in the VAT rate at 440 million. So in normal times, a 1% change in the VAT rate equates to 450 million. So 2% for 6 months is 440. If the government were to go with for a change from 13.5% to 9%, 4.5% change, that would have cost about 770 million in normal times. Now, we're not in normal times, and we're not suggesting that that was the main reason behind the decision to go with a standard rate rather than a reduced rate. In particular, the tourism and hospitality sector had been lobbying for a reduction in the reduced rate, as we did in 2011 when we brought it from 13.5% to 9%. But that didn't occur. Possibly it might be because in terms of generating a stimulus, it's often looked at if you change the standard rate as opposed to a reduced rate, you can stimulate demand across a number of sectors. And one point to note is that the government's hands were also tied in respect of the ability to change rates. For example, there were certain calls for a reduction in the rate applying to alcohol in the public sector, but there are EU laws which prevent, and actually Ireland, unless, for example, the EU Commission were to give special permission around the EU, Ireland would not be able to reduce its rate on alcohol below the standard rate. Now, if we look at how Ireland compares to other countries, Germany also reduced its standard rate. So again, for a 6-month period, they reduced their standard rate from 19% to 16%, but they also did go with a reduced or cut in their reduced rate, which is 7%, and they've brought that down to 5% until from July until December 2020. Other countries have brought in more targeted measures. For example, Belgium, Greece, Czech Republic, and in particular our near neighbours, the UK. So the UK have gone with a targeted measure of bringing the rate in their hospitality and tourism sector. They've gone from 20% to 5% for a temporary period. One country which has bucked the trend, and like we're not in Saudi Arabia, they've actually trebled their VAT rate. So they've gone from 5% to 15% with effect from 1 July 2020. In terms of how Ireland sits in the context of the EU, Ireland, we are a high standard rate country, so we had the highest, 7th highest standard rate in Europe before the change. Hungary has the highest at 27%. We're glad we're not trading in Hungary, and Luxembourg has the lowest at 17%. So the average rate in the EU, if you average them out, it's about 21.5%. So we're now just below the average for this temporary period. And again, it's worth noting that Ireland and Germany were the only countries to actually go with a standard rate change. The other countries to date have gone with a more targeted measure. Also worth noting that Ireland actually, we do have a narrower standard rate base than other countries. So we have a lot of products falling in the zero and reduced rate, in particular food for human consumption. So a lot of the basic food items you buy in a shop, they're actually zero rate in Ireland and the UK, but most countries on the continent will apply a reduced rate. And finally, if we compare ourselves with the UK, so the differential in VAT rates is now down to 1%. So Ireland will be 21% and the UK will be 20%. That's down from a high of 6.5%. So in 2009, Ireland was 21 and the UK had actually at the time reduced it to 15%. Now there has been talk about the differential in the Northern Ireland and Southern Ireland in respect of hospitality. So Northern Ireland applying the UK rate will be 5% for a temporary period of time, and Ireland will be 13.5%. However, when the UK temporary rate runs out, the UK will revert to 20%. Whereas Ireland in the tourism and hospitality sector, we do have the 13.5%, and we will retain that. So with that background in mind, I'm now going to pass you on to Phil Murray, who's going to go through the issues, technical perspective that businesses should think about in implementing the VAT rate change.
Thanks, Glenn, and good afternoon, everybody, and good morning, actually, to some of our friends in the US who've got out of bed early, I understand, to join the webinar. So good morning to you guys. I feel like I've drawn the short straw a little bit in trying to cover what changes with the temporary VAT rate reduction. It's something that might sound like it's quite straightforward, but it's actually quite tricky. Now, for some businesses, it may well be straightforward. If you do nothing but have a small retail shop, it's going to be clear that sales in August are at one rate and sales in September may be another. But lots of businesses operate on a different basis. And why is it so tricky, I suppose, is the question. The reason it's tricky is because, well, it's VAT, and VAT is always tricky. And the rules that are revolved around what rate should apply and what is the timing of VAT when I make sales, and sales are what most people are focused on. They're determined by a number of different things. So what influences what VAT rate should apply? Well, the date of supply of the goods or services. When do you make your sales? If a VAT invoice needs to be issued, when was that issued, or when should it have been? What if I got paid early? That can have an influence, we'll see in a little bit. And another one that influences the answer to the question what rate applies, and people often overlook this, is whether the business is operating on the invoice basis or the cash receipts basis. Now, people may or may not be familiar with the cash receipts basis. That's effectively a methodology where traders are allowed to account for VAT to revenue at the time they receive payment. And quite a lot of businesses operate on that basis. It effectively limits a limit of €2 million turnover per annum. It used to be much smaller, but a lot of businesses operate on that cash receipts basis rather than paying VAT at the time the invoice is raised. And that's important, as we'll see in a minute, because it can impact on the VAT rate change and which rate should apply. Okay, so lots of complicated rules. And what does that all mean for you guys or for a business? Well, hopefully you don't have to worry about all of the scenarios, and most businesses only have to deal with one or maybe two. But I like to think of the VAT rate questions as falling into sort of three different buckets. So analysing what kind of sale you're making is key to determining what rate should apply. So probably the biggest bucket, maybe most common, is what I'll call the B2B supplies. And by that I mean sales where you're obliged under the legislation to issue a VAT invoice. And that's usually when you're selling to another VAT registered person or a business customer. There's a list of people involved there. So the rule is pretty simple. Well, the VAT rate will be the one in time when you issue your invoice or should have issued your invoice. So if we look at that example, goods are sold in August of this year. The rate at then is 23. We know it's going to temporarily reduce to 21. If the invoice is raised in August, that's the VAT rate that will apply. But you are allowed under VAT legislation to wait until the 15th day of the month following sale to raise the invoice. And if you should do that, the rate at that stage will be reduced to 21%. So you potentially have a choice there, but whichever one you do will dictate the VAT rate. The next bucket I'm going to call B2C, so business to consumer. These are sales where you do not need to issue a VAT invoice to your customer. So if you think of a retailer, you don't issue a VAT invoice when somebody walks into a shop and buys something. And there's quite a big pot of people in that B2C category. So obviously, if there's no VAT invoice being raised, the VAT rate won't be by reference to when the invoice is raised, because there isn't one, but the VAT is due by reference to the rate that's in force at the time of the sale. So when this supply takes place. And similarly, in the last bucket, and this is why I mentioned the cash receipts people at the start, this sort of trumps the general B2B rule further up the page. If you're on the cash receipts basis for accounting, VAT rate is determined by the time of supply, a bit like the B2C. So those three buckets should capture pretty much all of your sales. And it's really the key is identifying which type of sale you're making, because that's going to dictate what the VAT rate is on that sale. Okay, because VAT is a little bit complicated and there's always exceptions to the rules, make it even more difficult. There are particular rules in VAT that will influence the VAT rate, and those are rules around payments in advance. So you hear the term deposit, maybe prepayment, advance. I'm not talking about refundable security deposits or anything like that. I'm talking about when payment is made early in respect of a sale, so it's consideration. Well, VAT rules effectively say that, look, if you get paid early, that for VAT purposes is deemed to be a sale of the goods or services up to the value of the amount you received. So while physically you may not have provided the service or sold the goods, you're deemed to have done so at that stage under VAT rules. And of course, because that happens, a number of consequences hang off that. So if I go back to the three buckets I spoke about, we've got the same three buckets again. And if I talk about the B2B people who are raising VAT invoices, receipt of the payment will result in an obligation to raise an invoice, and therefore your VAT is due when you raise that invoice, or should have. And the other two pots, the B2C guys and the cash receipts guys, if early payment is received, you'll effectively owe the VAT, and the VAT rate is determined by the time when you get the payment. So again, unfortunately, a little bit of a complication from the standard rules, but people will be familiar with that. And then maybe the final nuance in sales, I'll go on to the next slide, it deals with credit notes. So people don't tend to ask a lot of questions about credit notes when the VAT rate is the same, but it comes up a lot when there's a rate change, whether it's temporary or permanent. Probably the best way to think about credit notes is the VAT rate on the credit note should match whatever was on the invoice when it was issued. So that will cover most of your B2B type sales, obviously. We sometimes get asked about credit notes for the B2C, so business to consumer. I suppose as a general point, an invoice does not need to be raised in a B2C in a typical business to consumer type transaction, and often it is not raised. So clearly, if you're crediting something, you won't have a formal VAT credit note. If you did issue a VAT invoice for some reason, even though you weren't obliged to, then again, your credit note VAT rate should match what was on the original invoice. Okay, we'll move on then. They're all sales, and most of the queries we've been getting, people tend to focus on what's the impact for me on selling, because they're what I'm most concerned about, and I know I need to do something because that's my responsibility. Purchases are equally important. People forget about purchases a little bit because they think, well, that's somebody else's responsibility. The VAT treatment will be determined by the supplier, the person I'm buying from. That's somewhat true, but you do need to remember there are two types of purchases for Irish businesses. There are Irish domestic ones and there's non-Irish. So you just think about the Irish purchases. You do want to be happy when you receive an invoice and you're going to say reclaim the VAT that you've been charged the right amount. You don't want at some point revenue asking questions about, well, hold on, you've paid the wrong amount of VAT and maybe you don't have an entitlement to recover it. So you do want to be happy you're paying the right amount. If you don't have VAT recovery, clearly you want to make sure you're not being overcharged. Maybe the one that causes a little bit more difficulty and is one that is relevant for most businesses that are of any scale is buying in goods or services from outside of Ireland. Now, you're obviously not going to be issuing invoices for those, and you may or may not receive invoices, but it's important to be able to determine what is the VAT rate on those transactions. Maybe just to talk about a couple of those, people are probably familiar with the term intercommunity acquisitions. That refers to Irish businesses buying goods from somewhere else in the EU, from outside of Ireland. There's an obligation usually to self-assess or self-account for VAT. But the VAT rate will be determined at the same time as the tax point on receipt of the goods, or at the latest the month following, or if an invoice is received, it's that period. That's probably what happens in practice. Invoices are issued on sale, and that triggers the tax point and the VAT rate. Services are a little bit more complicated. There's an interesting interaction between when is my VAT due to revenue on the receipt of a service and what is the VAT rate. Both typically, and the legislation will state that it's the time of supply of the service. That can be difficult in practice to nail down. Sometimes it's very straightforward and it's really clear, but in other cases it's not so clear. So what typically happens is on receipt of the invoice or payment date, if you haven't received an invoice, the VAT obligation to the obligation to pay it and the appropriate rate will be determined. I guess it's fair to say that most of those items I've spoken about, they're most relevant for people who don't have full VAT recovery. If you have a business that has full VAT recovery, you want the VAT treatment to be 100% correct when you're buying in the goods and services. But if you've got full recovery and it's deductible, but shouldn't be as much risk as clearly there is for people who don't have full recovery or partial recovery. There's real cost and real VAT in play. So it's one that you do need to be careful on. That deals with most of the issues, I think, on sales and purchases, obviously the biggest transactions, but there's a number of other things. I won't get into half as much detail on these, but there are other things that it's not an exhaustive list by any stretch. But things that I guess people are asking us or maybe need to think about to see if it impacts them. Won't impact everybody. Pricing is a really obvious one. Lots of debate about whether a temporary VAT rate reduction should be passed on or not. Is it extra margin for the supplier? What it is, but that's a commercial call, and there are other things to consider. But just from a VAT perspective, are my prices VAT inclusive? Are they set as VAT exclusive? Do I have the ability to make the change? That's obviously relevant. We immediately think of retailers and people dealing with the public. There are also lots of businesses who supply goods and services to other businesses who don't have VAT recovery, and people involved in exempt activities or charities, government departments. There's lots of people who pay VAT and can't recover it. Similar type issues arise. Will there be a price reduction? What's the agreement? And some of that will be dictated by what if any, is the current contractual basis. Maybe my contracts don't allow me to change my pricing. Maybe they oblige me to do it. That's could equally be the case on sales being made by a business or purchases being bought in. So that's something that we need to be reviewed on a case-by-case basis. And certainly if people are involved with larger transactions and significant contracts and someone does not have full VAT recovery, they're things that people should be looking at, I would suggest. There are particular rules in VAT for continuous supplies. There are supplies where it's almost difficult to determine when is the date of the sale of the service, usually, because there doesn't appear to be a particular start and end point. There are specific rules in VAT for people who supply utilities like gas and electricity, and they're obliged to issue regular invoices and account for VAT. Probably the one we get asked most about is in respect to property lettings and landlords. But typically what happens as in practice is landlords will issue VAT invoices in advance. They raise the invoice clearly, and up until about 5 months ago, they got paid straight away, and clearly the VAT was due. That hasn't happened as much recently, but the invoices are still being raised. But what typically happens there is that, I say, the invoice is raised in advance of the period, whether it's a month or a quarter, and the VAT rate is determined by the date the invoice is raised. Slightly less well known is some traders operate a system whereby they issue a document at the start of the year showing the amount of VAT that will be due on monthly schedules. So this happens in the leasing and hire purchase industries. And this is a very, to be fair, what I call a minority sport. Not many people are impacted by this, but people who have issued documents at the start of this year in the expectation the rate would be 23%, may clearly need to revise that and have a look to see. They will need to amend those documents because of the impending short-term 21% rate. Not as much a technical point, goes without saying a little bit. If you're involved in a VAT exempt business, you're probably going to be thinking, while this may not affect me on sales, can I somehow take maximum benefit from the short-term reduction? So it's only 6 months, but whatever costs are incurred, whatever tax points are triggered by the purchases you make, would they be at 21 instead of 23? Great news if that turns out to be the case. Are there any steps that could be taken, discussions with suppliers, and that would help that to happen? It only 2% doesn't sound like a big difference, but it can be on a significant sum. So something to think about, and that equally applies to Irish and non-Irish suppliers. Some smaller things then, maybe just to think about, guys. Direct debits. Some people pay VAT every month by direct debit to revenue, and if your VAT liability is going to be slightly lower because the VAT rate reduction, then maybe that'll allow you to make slightly lower payments and help with cash flow. May not be much involved, but again, every little bit helps. The last couple of things then, I just want to briefly mention that may be of interest to people. Again, mightn't apply to everybody, but people probably aware where goods are imported from outside of the EU, VAT at point of entry is usually paid and needs to be reclaimed. But some larger businesses operate with deferment accounts, and because of the lower VAT rate that's coming, it may mean lower VAT amounts due on import goods, and that might mean that slightly reduced bonds or guarantees, which those traders sometimes pay to have the deferment system in place, they may be optional. But again, as I say, it's a bit of a minority sport. Just leave you with two more. There are people who think, well, it's an Irish VAT rate reduction, so I don't need to think about it so much if I'm not an Irish business. But clearly, if you are somebody who is obliged to pay Irish VAT either on your sales or you incur costs, even if you're not an Irish business, this may impact you. So, for example, lots of large entities will pay and currently do pay Irish VAT on services supplied to Irish consumers, and I'm thinking of online downloads for the music, video, broadcasting, telecoms. All of those people will be impacted by the change, as will people who we call distance sellers. That's a term used in the VAT world for people who sell product from outside of Ireland, somewhere in the EU coming into Ireland, and Irish VAT applies on lots of those sales because they're large enough and they exceed certain thresholds. So non-Irish businesses can be impacted as much as an Irish business by some of the changes. Last one I'm going to mention just sounds like a little bit of a silly one to mention. Well, which of my products and services are impacted? Now, you might say, well, that's going to be very obvious because whatever products and services I'm selling at the moment that are 23, they're the ones that are going to be 21, and that should be the case. But there are people who make sales of a combination of goods and services, what we call a multiple supply or a basket of goods. And sometimes those people have calculated a blended VAT rate as being the amount they'll pay on those sales. Obviously, if there's standard rated items in those baskets of goods or blended rates, the temporary rate reduction is going to impact on those, and you need to find how that will impact you from the 1st of September. So that's a little bit more of a systems issue maybe than a VAT technical point. And I think that could be a good point to hand you over to my good colleague John, who's going to take us through a little bit more in terms of what systems issues might need to be considered.
Thanks, Finbar. So if we think about this VAT rate change, I think it's worth noting from the outset that this will impact businesses in different ways. For a smaller business, this could be really just about maybe making some tweaks to the end of month VAT compliance reporting process that you have. Whereas for larger businesses, it might be a bit more complex. And the first point I think just to take a step back in is to get an understanding as to what systems are impacted from a rate change perspective. And that could be that I'm operating that B2C, that I sell to private consumers, and that if I do have VAT logic coming in through my tills, I will need to look at my POS or my point of sale systems to understand how they work. Alternatively, businesses might have what we call expense management systems. So for example, you may have Concur, Chrome River, one of those tools implemented. Again, you may want to consider how that VAT logic is being coded. For the larger businesses, they would run ERP or enterprise resource planning systems like SAP or Oracle. They'll need to consider how that VAT logic is impacted from a rate change perspective. More and more, we're seeing businesses introduce payable systems. So, for example, Ariba, Coupa, that manage the accounts payable process. That's something that is going to be impacted. And then, those systems are really around determination or allocating the VAT as it is charged to you in the business or as you charge that VAT to your customers. I think there's also a point worth noting with regards to thinking about the compliance reporting piece. And some businesses will have implemented VAT reporting software. So obviously, if we're calculating VAT at 21%, we need to make sure that what we put in the box or the return out to revenue is at the correct rate. And then the other one that I think is just a little watch out, having worked with a number of clients going through kind of their end-to-end compliance reporting processes, is that there is a lot that happens in Excel at the end of the month. It could be, for example, manually doing my reverse charge or my acquisition, just to make sure that there's no additional steps that you're taking in Excel at the end of the month or in advance of submitting a return to revenue, that they're not being missed. So how we typically see businesses applying a VAT rate, in particular from a sales perspective, is around the product file that they may have. And when you're engaging with IT or the business on all of this, you want to try and get an understanding, well, do I assign this rate at each individual product? A lot of the time we might see it by a merchandising class, or what we mean by that is a group of products that, you know what, we know everything in this category is standard rated, therefore we'll just apply the rate at the whole group of those items. A lot of the time you may have a rate in your system, but then when you actually go to sell that product, the system is looking at, okay, am I shipping to somebody in Ireland? If that's the case, I need to charge standard rated VAT. If it's an export to an EU, I know I need to do that from a dispatch perspective. So to really try and get an understanding as to what is the VAT rate logic that's residing in the system. I think there is a piece there, maybe a more commercial point as well, with regards to understanding the sales price, because a lot of the time there might be a price point that's set from a market perspective, which is inclusive of tax. So to really get an understanding as to, well, what rate change I have and how that impacts my overall pricing. One of the more tricky areas, because a lot of the times it is potentially a bit more of an art than a science from a tax technical perspective, is around these bundle goods. To really get an understanding of, I might have a couple of items that I sell together as one product. How will they be treated from a VAT perspective? Mindful that yes, there's the 23 coming down to 21, but I may have other items in that little bundling that will be covered. I think the other one to watch out is that although there might not actually be any VAT logic on the receipts that you produce, talking to a retailer that does produce VAT on the receipts, the thinking was, well, it's going to be a big effort to change in my point of sale system, so I'll just amend my VAT return. We need to be mindful that if we're doing something in our VAT return, but yet still producing receipts at 23%, rather than actually remitting 21% of revenue, there is a watch out. As Finbar mentioned earlier, if I'm in that B2C world and I don't actually produce a VAT breakdown of those receipts that I issue to my private customers, that leaves you a bit of flex with regards to how you might approach that. Some of the other considerations, Finbar went through some of the technical items that need to be considered. And again, I think it is important as you tease that out with your IT teams or whoever will be supporting you on this VAT rate change, because systems are really, the logic is if, then, do. And it's really about trying to get an understanding of some of the rules and exceptions that Finbar covered and build that out into some sort of logic so that this is managed in an automated way. There is that need to ensure that any changes you make, you do a certain degree of testing. And then the final piece is around this interdependencies piece. Now, admittedly, this more impacts the larger businesses, whereby I might have some scanning software that brings in my accounts payable invoices. That might go through a procurement system like Ariba, then it might be posted to SAP, then that posts into my VAT journal, and then that goes into my VAT return working papers. Just remember that, VAT for some of the larger businesses goes through a journey, through a number of different systems. So just to make sure that if you're thinking about a change in one, you kind of look left or right to ensure, okay, if I make this change here, what could be potentially the knock-on effect of making this change here? So if we move on to kind of thinking about key next steps, to me, it doesn't really matter whether or not you're a small mom-and-pop business, an SME versus a large multinational. I think it's really important to engage with IT straight away now. But the rationale behind that is that, if you're a small to medium-sized business and you have a local IT provider that manages your billing system, you know, you're probably not going to be the only small business that's going to be going to that person looking for assistance on the rate change. So again, try and engage sooner rather than later. If you're maybe a more larger or a complex type business, it's worth noting that IT will have system development freezes or maintenance freezes where basically, guys, I'm sorry, the system is a no-go area. We're doing some work on it. You can't make these changes. So again, the rationale about engaging with IT up front is that we're going to go through some practical next steps in the next few phases here. But what you want to avoid is you've done all of your homework and then you go to IT at the 11th hour and they're saying, sorry, no can do, get to the back of the queue. I think I touched on it before. It's really about assessing where do I have this existing 23% VAT logic, and typically we find it's going to be in my order to cash and procure to pay processes, maybe a bit about expense management as well. Think about your end of month reconciliations, GL postings that you do, because again, any change here, you just want to make sure that you're seeing that through from an end-to-end perspective. And again, just to ensure that you might have done everything great from a systems perspective, but a lot of the times what systems produce is what we call a form, which is the invoice. We just want to make sure that 23% isn't still sitting there. Instead, we've got a 21%. Once you've got an understanding where those rate changes are residing, it's really about understanding your requirements. And I do think there's a point to step back here and right size the answer. And I said at the beginning, you could be in a retail environment whereby you don't produce receipts, and you may make a commercial decision that I'll maintain my pricing as it is, and I will, in the background, ensure that I'm remitting 21% to revenue. Versus a more complex business may need to take deeper steps. And I think by first of all understanding what you have to play with in that assess piece, you're in a good position. Maybe try and bottom out some of the points that Finbar was talking through with regards to some of the tax technical considerations. Because again, when you're looking to engage with your IT folks, if you've bottomed those out, you really, really are in a much better position. Some businesses may want to do a certain degree of working capital modeling. What would be the impact here from a working capital perspective, from a cash throughput perspective, because obviously VAT does represent a sizable portion of that. We then kind of go into build, test, deploy, which we see in most IT type projects. And, as we mentioned earlier, the types of changes we're envisaging would be around your master data, around some of your system VAT logic, your invoicing, and your reporting. I think what's important, we've spoken a lot around the systems piece. I think there's a little process piece to this as well. And Glenn at the beginning mentioned that I think there's six countries in total, Ireland 1 and 5 others that operate VAT at 21%. So let's just think about it again. If you're a large business and you've offshored all of your accounts payable processing to a shared service center, how will they understand? Typically we had 23%. Yes, that's Irish VAT clearly. But now, how do I maybe distinguish that 21% from Spanish or Lithuanian, whatever country that is also operating that 21%? So, I would consider that change management piece. And then maybe as well from a B2C perspective, maybe just from a client service perspective or customer service perspective, to think about what that rate change will need. I think then when it comes to deploying, you obviously want to make sure that you'll have previously factored in some testing. But one of the things I would humbly suggest is that for the first month or two post go live is just to put in an additional piece around two things. One is just a bit of time with regards to doing some reconciliations, just in case there are any issues that have arisen. And then secondly, you may want to consider doing some additional assurance testing around, okay, I've put these in place. This has been running for the whole of September. Let's maybe take a step back and see how that has actually played out in practice. So with that, I'm now going to hand over to Ethna Kennan, a director in our indirect tax team, who's going to cover some working capital opportunities from a VAT perspective.
Thanks, John. Yep, I'm going to start looking at the warehousing of VAT liabilities and the benefit of this for businesses. And to put this into context, to give some background, you'll be aware that Revenue had previously announced that debt collection and also the charging of interest on late payments of VAT would be suspended. And that would be for the January, February, the March, April, and the May, June 2020 VAT periods for SMEs. And in that context, Revenue had said that an SME is a business with turnover of less than €3 million and one whose tax affairs aren't dealt with by either Revenue's large corporates division or Revenue's medium enterprises division. So administratively, SMEs are managed within Revenue from both a service and compliance standpoint by their business division. Then Revenue also announced that entities who wouldn't fall within that definition of an SME and who would be experiencing difficulties as a result of COVID should liaise with Revenue on an individual basis to reach agreement about deferring VAT payments. And as part of all of this, Revenue said that taxpayers would need to continue filing VAT returns in the normal manner. So what we're looking at next then is trying to give businesses more certainty about this. So in order to give more certainty and more comfort about the parameters involved, in May, the government announced that it would legislate to provide that Revenue will warehouse deferred VAT liabilities associated with the COVID-19 crisis. And the draft legislation to achieve that was issued there on the 24th of July, with the plan being to insert a new provision into the VAT legislation, whereas Revenue would currently be operating the arrangements on an administrative basis. So under this draft legislation, the scheme is involving the effective parking of unpaid VAT liabilities that arose as a result of COVID-19, and that would be for a period of 12 months after the business has resumed trading. And then after that, the arrangements would involve the application of a lower than normal interest rate of 3% annually until the time that those COVID-19 debts are paid. And in that, it's important to remember that the interest rate, normally the regular interest rate in VAT, is 10% per year. There is a quid pro quo, though, that the draft legislation is pointing to a requirement to comply with all relevant compliance obligations. And the question is whether this could inadvertently lead to businesses no longer being considered eligible for the relief because of innocent administrative errors. And it does remain to be seen how Revenue will approach this in practice. And again, bearing in mind, this legislation is in draft. But so far, our experience has been that Revenue are being pragmatic and reasonable when they're dealing with businesses about these COVID-19 requests. So we'd be hopeful that this approach would continue. Practically, what does it mean for you when you're looking at trying to map out warehousing for your business? It does involve mapping out your calendar and breaking down into 3 segments of time. These are referred to as periods 1, 2, and 3. Period 1 commences on the later of 2 dates. It's the later of either the first day of the bi-monthly VAT period that immediately precedes the bi-monthly VAT period during which your business was adversely affected by COVID-19. We're currently in the July-August 2020 taxable bi-monthly VAT period. And period 1 is the later of that date or 1 January 2020. And a business is regarded as being adversely impacted from COVID-19 from the bi-monthly period during which Revenue agreed to temporarily suspend collection of the liabilities to do with COVID. So taking an example, if this occurs in the March-April 2020 VAT period that Revenue have made that agreement, period 1 would beginning in that situation from January-February 2020, which is 1 January 2020. Period 1 ends on the last day of the bi-monthly period after the bi-monthly period in which your business has ceased to be subject to these restrictions or your business has recommenced trading. Now, in terms of the warehousing, this means that the VAT liabilities that are built up during this period where your business was not able to trade normally because of COVID-19, plus the 2-month period after the time that your business has recommenced trading is within this period 1 warehousing. And during this, no collection of VAT liabilities would arise by Revenue. The other upside is that no interest will be charged by Revenue on the unpaid VAT liabilities. So period 1 comes to an end. When does that happen? We've talked about the end date there, and that'll move you into period 2. Period 2 then runs for a 12-month period after period 1 has ended. Now, period 2 can be extended by ministerial order, but it can be no later than 31 December 2022, so the end of 2022. It does mean that different businesses, though, could have different periods in period 2. During period 2, what's the upside? The upside is that no interest is charged by revenue, but this is on the VAT liabilities relating to period 1. And it's important to remember that taxpayers will be required to pay your current VAT liabilities as they arise, being those VAT liabilities starting from period 2. Then we have period 3. Period 3 starts from the end of period 2 and lasts until the time that your VAT debts that arose during your warehouse period of period 1 is actually going to be paid in full. Now, the upside here is we're talking about a reduced interest rate of 3% annually that will be charged on the VAT debts from period 1 that remain unpaid. And again, to remember that that's compared to the regular interest rate on VAT, which is 10% per year. There are some points, though, to think about on this. A business is required to agree a payment plan with revenue before period 3 starts in order to avail of this reduced interest rate. Another point to be aware of is that the draft legislation is saying that interest, this lower interest rate, would be arising on the full amount of the debts that are unpaid at the start of period 3. And it remains to be seen whether, before the legislation is finalised, whether any credit will be built in for amounts that you may have repaid, or will it remain payable on the amount that was due on day 1. Now, after looking at warehousing, what I'd like to move into next is about maximising VAT cash flow, as Glenn said, to try to look at some positives as well that you can do for your business. What we're seeing is that businesses may not be at the moment having the headspace or the ability to focus so much on VAT cash flow enhancement reliefs and other reliefs. And this could be because of the understandable focus right now on the VAT liability warehousing that I've just touched on. But it does remain the case that although warehousing is such a positive benefit for businesses, it still remains the case that debts will have to be paid at some stage. So it's certainly worthwhile looking at now, are there other ways to help VAT cash flow or perhaps even stop debts building up? When we look at the VAT throughput for a business, we see that there's often a challenge in managing the fact that VAT needs to be paid to suppliers and it's included in the amounts you pay to your suppliers versus your ability in the business to recover a VAT input credit on those purchases. And again, it can be a challenge to manage your obligation to pay VAT on your output, supplies to revenue, versus your ability to collect VAT included in the payments that you're getting from your customers. So when we look at COVID and the related shock to the global economy, there can be, as we know, a major cash flow challenge for businesses. And that's why effective management of VAT and other indirect taxes can really make a difference for your working capital, in particular because of the timing and quantum of your VAT inputs and outputs. What we're thinking of here is about simple changes based on current best practice that could actually improve your working capital position. What would these look like? Well, first off, to familiarise yourself with what are in fact the VAT relieving measures that revenue or tax authorities abroad have introduced for taxpayers on COVID. So that'll be in Ireland, as I said, or in other countries, to familiarise yourself with these. Quite apart from these COVID measures that may have been introduced, what is happening about securing VAT refunds as soon as possible in your business? What steps can you take to secure those VAT refunds as early as possible? And that could look like filing VAT returns as early as possible, engaging with the tax authority, and also having your supporting documentation ready. And also asking, is it possible to offset a VAT refund against other tax liabilities that you're facing? John had previously mentioned about the importance of operational processes for VAT. And again, just to recap on some thoughts on this, have you considered, are you claiming the correct amount of VAT at the earliest time possible? Are you looking at any invoices that are being parked or about accrued invoices that are posted after the closing out of month end? Could any changes to your procedures about timing of raising invoices to your customers improve your cash flow? In a situation where a supplier effectively knows that they won't be paid for a particular transaction, and to avoid debts building up, is it possible, and we've seen some businesses considering this, to apply effectively a de facto cash receipts basis and to consider pro forma invoicing? Are you capturing all the VAT that you're entitled to reclaim? That might include VAT on imports, your employee expenses, and these can all add up, as we know. And also we've seen businesses considering introducing self-billing. and self-billing procedures with your suppliers so that you can help manage and try to get better control over the timing of receipt of VAT invoices. The right fit for your business is going to depend on the VAT throughput in your business. So it's really important to be looking at that and gaining an understanding of it. But it doesn't stop there, because of course there are other enhancement steps that you could look at. A reality that we think will feature more is about bad debts. And where certain conditions are met, it is possible to claim bad debt relief for VAT purposes if you've remitted the VAT to revenue and it hasn't been paid by your customer. So what's a practical step? This would be where aged debtors listings and also bad debt provisions, they should be monitored on a regular basis to identify if this VAT relief could actually apply for you. You could consider whether an accelerated bad debt relief claim can be implemented. Unfortunately, though, we need to remember that you can't issue a credit note as such for an unpaid debt unless it's the case that you've agreed an adjustment or a price discount with your customer. Retained deposits can also feature, especially in B2C cases. So if you're seeing that customers are cancelling bookings and a supplier, in your case your business, has already accounted for VAT on that deposit, it may be possible to make an adjustment for the VAT amount if certain conditions are satisfied. For businesses that import goods into Ireland, let's look at reliefs in respect of imports and duty. Are you managing your import VAT and duty process as efficiently as possible? And especially for larger importers, could you consider the availability of any deferrals or any suspension regimes for VAT, for customs duty, and in terms of goods coming into Ireland from outside the EU? We've been looking here at measures that either have been triggered because of COVID or already exist. And there are further measures that already exist in Irish VAT law for qualifying businesses, which can have a positive VAT cash flow impact. You may be aware of a number of these. So to start, VAT grouping. If you have a situation where related companies are making supplies between them, VAT grouping those entities can really alleviate VAT cash flow on intra-group supplies. You may also have seen that businesses that predominantly dispatch goods from Ireland can qualify for a cash flow relief, the one that's referred to as Section 56 authorisations. And where this application is made to revenue, it can allow those types of traders a significant cash flow relief, in particular being able to purchase in most goods and services at a 0% VAT rate to begin with. And then also, Finbar has mentioned previously about the cash receipts basis of accounting for VAT. So it's certainly worth considering whether the business is able to qualify for that, bearing in mind the turnover threshold, and also another way of qualifying where the business is mainly supplying the activities to non-registered customers. So what we're recommending is that as a business that you look at the throughput of the VAT in your business and then identify what's the best fit for you in terms of cash flow enhancement on top of the warehousing that we've been talking about. So at this point, I'm going to hand back over to Glenn.
Thanks, Etna. That was very insightful. And I think what jumps out to me is maybe what you can do is make a real difference to the business and bring some efficiencies through quite simple measures, in particular to boost cash flow. Conscious of the time, I know we're a little bit over. We've got a lot of questions in, so we're going to go into a little bit of overtime, but there'll be no penalties, I promise. So we'll just take a couple of questions. The first one, maybe for you, Etna, 2 questions on warehousing. So first question, when does period 1 end, and does it also apply for payroll taxes? And a related question, which I think you could probably deal with as one, is if an SME continues to experience difficulties in July and August of 2020, can they be warehoused, or is it only available for the first 3 periods of 2020?
Okay, no, thank you for that. So in terms of your period 1, it's based on bi-monthly VAT periods. So it has started at the start of the VAT period that preceded the VAT period during which revenue was saying that you are accepting that your business was adversely affected by COVID. So in the example I gave earlier, it can be no earlier than 1 January 2020, but it ends in the VAT period after the VAT period during which you cease to be subject to those restrictions or that you actually began trading again. It also, there is a similar relief in respect of payroll, so it's not just limited to VAT. And then I believe the other question is that if you're continuing to experience your COVID-related trading activities, what liability can be warehoused? So it is important to remember that The warehouse liabilities are those for period 1. And then in subsequent periods, once period 2 begins or period 3 begins, what you're looking at is the regular obligation to be meeting your obligations and your compliance requirements, and that the warehousing is restricted to your original accepted COVID-19 liabilities.
But there isn't a line drawn in terms of July, August. Businesses who are still impacted can continue to warehouse.
Oh yeah, absolutely. And thanks for this point to clarify. Absolutely, because what we're looking at is we could have different periods for different businesses, and depending on the date that the business has in fact recommenced, and can show that to revenue after COVID-19 has impacted their business.
Yeah, perfect. Thanks. Finbar, I'll maybe ask you this one. It's a good question. Is the reduced rate of VAT of 21% applicable to all services? For example, a sole trader, plumber, or carpenter providing services to a hotel. So is the reduced 21% applied there?
Okay, yeah, mixed bag of stuff. Thanks for the question. So the standard 23% rate is being reduced to 21. That's across the board. Important to understand that there isn't a defined list of what is subject to the standard rate of VAT. So we have schedules with items that apply for the reduced rate or an exemption or even zero rate, but the standard rate is sort of a catch-all rate that captures everything. So there was some talk initially about it may only apply to certain things within the standard rate, but no, the standard rate is across the board, whatever it applies to. Just to mention if the question, sorry, I think you mentioned again, carpentry services, or those types of services are possibly something that will be subject to the reduced rate of 13.5, I suspect, and so possibly not impacted by the standard rate reduction. But so there's almost two questions in one there. But no, it's across the board temporary reduction of everything that the standard rate currently applies to.
Perfect. And maybe one last technical question: which FX rate should be used for a credit note if it's been issued in a foreign currency? That's a good question in terms of.
No, it is, and we deal with questions about FX a lot because lots of people are involved in transactions that aren't in euros. So what people sometimes don't realise is an Irish VAT invoice needs to have a euro VAT amount on it for the VAT, and that's for good reason. Clearly, you wouldn't want a supplier issuing an invoice in a currency and then paying a different amount of VAT than the purchaser is entitled to reclaim because they're maybe using a different exchange rate. So the euro VAT figure that needs to be on the invoice is clear, and both parties are operating that way, and therefore you're going to have the same euro VAT figure on the credit note if one is issued. So yeah, there are lots of different stuff that needs to be included on a formal VAT Irish invoice, Glenn, and as you know, one of them is the euro VAT amount. So that sort of deals with the exchange rate question.
Perfect. I'll close it off and I'll give the last question to you, John. It's a systems question. So what are the main issues that I need to consider from a systems perspective?
I think very briefly, Glenn, the three watch out, or I think where the sport will be around this will be one, maybe credit notes exceptions, because they're going to span multiple periods. You need your 23% credit notes going against them, then you have credit notes that will relate to this 21% period. I think the time, this is something that needs to be done in a timely manner, mindful that we are in holiday season. And then finally, just not covering all of the process. You might do a really clever quick fix here just to make sure that you're aware of the knock-on impacts that might have.
Yeah. Thanks, John. I think we'll wrap it up with that. I'd like to thank everyone for dialing in, and I hope you found it useful. The next this was a bonus Lunch and Learn. The next planned session in our Lunch and Learn is on the 18th of August. We're actually going to look at managing your VAT compliance and overall process. And we go into some of the points we talked about today in more detail. And then we look at issues, for example, how do you do your VAT compliance when you're out of the office? What efficiencies can you bring in terms of managing VAT in these difficult and challenging times? So again, I'd like to thank everyone. And the slides will be sent to everyone who's registered for the webinar with the recording as well. So if you want to do a playback on it, you're very welcome. So thank you everyone for your time.